Europe is quietly moving its factories south, not to Eastern Europe, but across the sea, to North Africa. Tunisia, Morocco, and Egypt are becoming the new workshops of the West. And Turkey? Caught in the middle, it's both losing ground and seeking opportunity. In this video, we expose the economic forces reshaping the industrial map. Today, we'll uncover how currency, wages, and political fragility are redrawing the global supply chain. This shift is not sudden. Since the 1970s, globalization pushed production to where labor was cheapest. But with rising costs in Asia and rising wages in Eastern Europe, the new frontier is the southern shore of the Mediterranean. Countries like Morocco have been laying the groundwork for decades, investing in infrastructure, trade zones, and EU-aligned regulation. Historically, France and Spain had deep colonial and economic ties to the Maghreb. What we see now is not a rupture, it's a reconnection. And when you trace back the power structures, you realize this was always the plan. In 2013, Renault opened one of its largest factories not in France or Eastern Europe, but in Tangier, Morocco. Why? Labor costs were 5 times lower than in France, and goods could reach Europe in 2 days. The plant was tax-free, backed by Moroccan subsidies, and strategically placed near a major port. The real blow came when other firms, Peugeot, Siemens, and later Turkish textile giants, followed suit. It wasn't just about cheap labor, it was about escaping the political costs of European Union and the rising financial burden in Turkey. Why is this shift accelerating? Let's talk numbers. In Turkey, rising wages and a strengthening currency have eroded export margins. In 2020, a Turkish exporter could sell goods with an exchange rate of €1 to 7 Turkish liras. Nowadays, that euro buys 47 Turkish liras, but with high inflation and interest rates, the cost base has also soared. Meanwhile, in Morocco, labor costs are low, logistics are modern, and agreements with the EU ease friction. For Europe, the African strategy is also political. Nearshoring without bringing jobs back home. And for Turkey, the dilemma is sharper. A strong lira reduces competitiveness and drives factories to cheaper, more predictable markets. A silent erosion of industrial power. Today, North Africa is no longer just a low-cost option. It's part of Europe's supply chain. Germany is funding railway projects in Tunisia. French firms are building data centers in Morocco. Even Chinese players are investing in Algeria to bypass EU-China tariffs. It's a strategic rebalancing. Meanwhile, Turkish companies like LC Waikiki and Aeroglue are shifting production to Egypt. It's not abandonment, it's insurance. In a world of currency risk, regional instability, and shifting alliances, production is following predictability. And North Africa, surprisingly, delivers just that. But there's a risk no one talks about. Remember when Egypt's Suez Canal was nearly renationalized after political upheaval? Or how Libya's collapse sent shockwaves through oil supply chains? If the West is building its industrial base on politically fragile ground, the next crisis could freeze an entire segment of the global economy. What looks like an economic solution may be the next strategic liability. Factories are moving, maps are changing, but who is really pulling the strings? Is Turkey outsourcing its future? Is Europe rebuilding an old empire in new clothes? If control over energy and raw materials gives power, control over production flow gives command. Henry Kissinger. If strategy, history, economics, and finance shape the world, this is where they converge.